Well, welcome everybody to our Q2 Quarterly Perspectives webcast. It is our first, though, under our new name, Forvis Mazars, and our new color scheme here, effective June 1st. Forvis LLP in the U.S. and Mazars, we'll just say internationally, came together to form a new global, two-firm global network. You take the total of us combined, we are 40,000 employees across 10 countries. In the U.S. now, we added to Forvis the folks that were with the Mazars organization in the U.S. So now we are 7,000 people in the U.S. and around 80 locations. Looking forward to all we can do together and what we'll be able to bring to our clients in terms of this new global reach we have as we've put two big puzzle pieces together and now cover the globe. So looking forward to that from our perspective and coming to you again for the first time as Forvis Mazars with the new color scheme here. I am joined now, consistent with the past, not new, by a great panel, starting out with Liz Gantner. She is a Regional Assurance Quality Leader, a RACL as we call it. Liz has worked with every organization that can be represented by any initials in the accounting profession, and is always glad to have her joining me.
Thanks, Greg.
Joined today also by two special guests. Our first special guest, Stephanie Jarvis. She's a director in our consulting group, IT Risk and Compliance. She's going to be talking to us about some IT topics. We are very glad to have her. We are actually going to be losing her in a sense as part of the new global network. She's going to be taking an assignment on the international side, going to Paris for a couple years to work with the legacy Mazars organization. So now Forvis Mazars internationally in terms of some of their IT work and structuring and approach. So very happy to have you here with us today, Stephanie. You know, we're going to be disappointed to lose you, if you will, from our work. We're looking forward to having you taking that role with the global organization. So welcome, Stephanie. And then finally, I'm joined today rejoined, if you will, by returning special guest, Adam Roark. Now, I alluded to some technical difficulties with my computer, so it's very easy to introduce Adam here. He's going to slip into the screen.
Thanks, Greg.
And has been very willing to share his office with me as I can host the event here. So glad to have these folks with me. Liz, we're going to get started with our typical look back section. As we do that, let's put a polling question out there first. Again, you need to answer 3 of the 4. What are you streaming or watching on TV this summer? And I say TV in quotes. My youngest daughter is getting ready to move into college for the first time. Asked her about what TV she was going to bring for the dorm, and she just laughed and said, "Dad, nobody brings TVs anymore. We all watch them on our devices." So put TV in quotes there. But answer this question. Are you binge watching something for the umpteenth time? That would be my wife and Dalton Abbey and Wind Calls the Heart. Are you watching a new series for the first time? That's me. I'm enjoying The Night Agent is one that's out there. Are you waiting for the Olympics, or are you like my oldest daughter who just simply has a stack of books next to her desk? So we'll put that polling question out there to get the ball rolling. And Liz, look to you. What have you seen out there in this last couple of months here?
So thanks, Greg. I appreciate it. I'm hearing a lot about sort of disclosure overload and some frustration by our clients on just the volume of disclosures that seems to be unending and relentless. From a peer review standpoint, I can share with you that revenue disclosures seems to be a pretty common conversation that peer reviewers are having with firms, that the financial statements don't have all of the necessary ASC 606 revenue disclosures. I'm going to imagine we look out another year and we might start to see the same types of trends either with lease disclosures or with CECL-related current expected credit loss disclosures. So there are some pockets where the new CECL standard was a lot more impactful to the client. For example, they may have been a financial institution or perhaps an auto dealership with some financing receivables, and it took them some time to implement the new CECL standard for expected credit losses. But I think a lot of the emphasis has been on the accounting, and we've not had the proper emphasis maybe on disclosures. I don't know, Greg, how long is the disclosure checklist that we use as a firm? Couple hundred pages, I think.
350 pages, something like that. I'm sure many of the participants here are provided or obtain a checklist from somewhere, and it's, you know, astronomically long in terms of what I know you and I probably saw at the beginning of our careers compared to what we have today.
Yeah, so I mean, this is certainly something I'm empathetic to, that if you have to review something that's 350 pages long of detailed disclosures, that you lose focus somewhere in the middle of that thing, and you start to just think everything is not applicable. So my advice to everyone is to make sure that they have a subscription service to a good disclosure checklist if financial reporting is part of your wheelhouse. I would also recommend that you concentrate on things that have changed or things that are new. So a new standard certainly would be something that you'd want to focus on. And sometimes it's not easy to find where those disclosures are in that checklist. So some of our team struggled with the fact that there wasn't a section called new CECL disclosures. You had to go find them embedded in other areas within the checklist. And so they can hide themselves. And so make sure you understand where those new disclosures may be lurking inside the disclosure checklist. Talk to your accountants, your auditors about some ways to improve the ability to get those disclosures right on the front end. I'd also be very careful about just calling them immaterial on their face. We calculate materiality on engagements, and we usually use financial statement results to calculate materiality, and to parlay that over to errors in disclosures or omissions in disclosures can be a little more problematic because it requires a little more thought. It's not a one-for-one dollar type of thing. So is an omitted disclosure or an omitted partial disclosure or an error in a disclosure, is that material? Often people come to a conclusion that it's immaterial without a lot of thought and without a lot of documentation. So just some food for thought about disclosures continue to be on the rise for the importance. And my last thing I'd like to talk about is cash flow statement. You mentioned it, I think, on our last quarterly perspectives. Cash flows is largely disclosure. It's not a lot of accounting, it's disclosure. Where do you put stuff? How do you classify it? Where's the geography of where something goes on the cash flow statement? And certainly we've seen an uptick in conversations from regulators about the importance of that cash flow statement. When that starts to happen, you're going to see an uptick in inspections looking for that as well, whether it's an internal inspection or a peer review type of inspection. So watch out for disclosures. Make sure you've got a good source.
Thanks, Liz. Excellent points there. What's kind of caught my eye over the last couple of months has been, with regard to the SEC, some, I'll call them legal challenges, if you will. If you think back to end of 2023, the SEC received news. They had a new rule out there on disclosing share repurchases, and at the end of a bit of a process, they wound up having to basically get rid of that rule. It was challenged when it was released. Not the Supreme Court in that case, but a circuit court, an appeals court said, hey, you didn't follow your own administrative procedures to issue that rule in terms of what we believe, the court believed, was listening to and responding to and thinking about comments received. So since you didn't follow your rules, you need to kind of fix that. And the SEC wasn't able to do that in the period of time. So that rule was basically vacated by the SEC and then the court. Shortly after that, they do the climate disclosure rules, and immediately there were lawsuits around that. So that's been in litigation now. But in the last couple of weeks, actually, there have been a couple key cases out there that came through the Supreme Court that are going to touch the way the SEC operates. One of those, this first one here, is actually two cases: Relentless versus Department of Commerce and Loafer Bright Enterprises versus Raimondo. Those two cases are coupled because certain of the Supreme Court justices were recused from one or the other. So by putting them together, all of them could address this same question. These were both fishing enterprises that were were suing over new laws from the Department of Commerce around regulating certain aspects of their fishing operations. And they were making the argument the regulators, the agencies went too far. And the court came through, and the Supreme Court has overturned what's called the Chevron doctrine. It's about 40 years of established law from a previous Supreme Court ruling. In that case, only 6 of the justices could participate because the other 3 were recused. So back then, it wasn't even a full panel of the Supreme Court. But that case resulted in the judicial system giving a lot of deference to agencies as they were setting rules and interpreting rules that had some type of attachment to what may have been congressional action. Gave them a lot of latitude and a lot of deference to what they did. This new case came through, and this current Supreme Court said too much deference to the agencies. Those agencies are not elected officials as Congress is, although they are appointed by the executive branch, but too much power vested in them. Basically, the judiciary needs to exercise their powers in terms of deciding what is, should, would, could be a law and interpreted. So that case has overturned the Chevron doctrine and is going to require, provide a lot more opportunity for companies to challenge regulations, period. And that's going to affect what the Supreme Court or what the SEC might be doing in terms of its rulemaking ability. So that's something that's going to touch the SEC, not directly at them in this case, but will affect what they do. And another one that was directly at the SEC was SEC versus Jarkesi. This case, an individual had gone through, was being accused of fraud, prosecuted for fraud, if you will, by the SEC. And at the end of this case, the determination was made that the way the SEC prosecuted the case using their internal administrative law judges to come up with the determination that fraud had occurred and impose a fine. Those administrative law judges, the way they are appointed and the way they are functioned, essentially violates the Constitution, due process, and the right to a trial by jury. And so the SEC has been told your use of administrative law judges isn't in compliance with the Constitution. Now, in fact, the SEC knew this case was coming down. It's been several years, as you can imagine, things go through the appeals process. So they had stepped back from that a while ago in terms of their focus on using the ALJs. So this was not necessarily a surprise, but now it is settled law, and the SEC is going to have to, in a matter of fraud cases where they can't work out a arrangement with the registrant, if it's going to go to trial, if you will, it's literally going to have to go to trial in the court system as opposed to within the SEC's administrative law process. So another case that's going to affect the way the SEC does business, if you will. So Liz, that's caught my eye. A lot of things happening out there in the legal environment that are going to affect the way the SEC may be able to do its business. So it'll be interesting to watch that. That's not all we've seen out there in the legal environment, though, right, Liz?
Well, so what do you think about this non-compete agreement with the FTC? I've got every client that's got non-compete agreements. What is your take on where that's going to go?
Yeah, no, you're right. This is a final rule from the FTC. It basically bans non-compete agreements. There are some very narrow exceptions out there. Narrow exceptions, they're going to grandfather non-competes with senior executives. And as you can imagine, there's a lot of rules around what constitutes a senior executive. They're going to allow certain non-competes in bona fide business combinations or sales of businesses. And they've got a exception for arrangements between franchisees and franchisors. But absent those narrow exceptions, there's essentially a complete ban on non-competes. And those that are in existence will be essentially torn up. This rule kicks in early in September. So your first thought around accounting is, well, we've got some of these intangibles we may have booked for non-competes. Well, wait, didn't Greg just say there are some exceptions for bona fide business, sales of businesses? Maybe so. Maybe that will preserve the value of some of these intangible assets, these non-competes from typically we see in business combinations. But there's a lot of nuances to that law. So there's some things here that are going to have some accounting consequence. Now, again, you might imagine lawsuits have ensued. At the moment, there's a very narrow injunction on enforcing the laws, like possibly the legal community is saying that's likely to be expanded to an overall injunction. That hasn't happened yet, but they're thinking it might in the very, very short term, week or two type time frame. But as written, this thing kicks in on September the 4th, and there's a lot of process you have to follow in terms of notifying people who have non-competes that they are no longer effective. So this is one, Liz, for I think all of our clients who have non-competes of any shape or size, keep an eye on if this hasn't caught your ear. Not only will there possibly be accounting consequences, but there are also true operational consequences in terms of the way you may be doing business with certain executives, other parties that you're kind of related to. So that Liz, that's caught our ear as well from a legal perspective.
Yeah, so I think my advice would be you might want to talk to your attorney, to whoever helped you draft perhaps the non-compete agreement, and then stay tuned, because I think there's going to be a lot more over the next 2 months or so as we approach the September date. So probably see this again on another Quarterly Perspectives, I think.
It might be maybe a good topic for a future one. All right, so that's what we've seen and look back. Now we're going to move to the here and now. And in the here and now, we're going to talk about cyber. A lot of talk around cyber incidents. We're going to push this next polling question out there. It says, polling question, have you been involved either directly or indirectly in a cyber incident? Yes, no, not sure. Pleading the Fifth Amendment or not applicable. Maybe that Fifth Amendment might be one that caused a cyber incident. We'll let you answer that as you need to at your own discretion. But we get the results back from that. We want to start talking a little bit about this. We're going to bring in Stephanie. She'll pop up here on screen in a minute. But a quick reminder to everybody out there, for the public companies out there, we've already seen a lot of movement in terms of disclosures around cyber incidents. We had a new rule by the SEC. It came into play for the last 10Ks, if you will, the 12/31 10Ks, and those that still have year ends that are still trickling out, those will be hitting as your 10Ks come through, required disclosure of your corporate governance structure over cyber incidents, over cyber management, managing those risks. What's the role of management? What's the role of board? Who does what? How are things communicated if something were to come out? So some disclosures required in the 10K. As part of that rule, there are also disclosures that are required for incidents. And let's look at here. We've got, it says almost half have been involved in one way or another. So that'll be interesting as we go through these next section here, Stephanie. But let me wrap up here. So we're talking about there's requirements now, and it had been deferred or delayed. There were the big companies, and then the smaller companies came in. It's now effective for everybody. If you have a cyber incident as defined, there are some very quick reporting requirements in terms of an 8K once you've determined that is a material cyber incident. And it goes, you can imagine there's a lot of words around that. And in just the short time this rule has been effective, the SEC has come out with several iterations of continuing disclosures or interpretive guidance, a lot in the form of what are called compliance and disclosure interpretations, CD&Is. So of very interest to the SEC, a very new rule, and something that affects not just publics. This is disclosure by publics, but it affects our privates as well. Anybody can be subject to some type of cyber incident. So with that, Stephanie, let's bring you in. And what are your thoughts as you see what you're seeing in serving companies in this space and the IT side, especially related to cyber?
Yeah, thanks, Greg. I think the biggest, and easiest question to, for everyone to ask themselves is, it's not a matter of if, it's a matter of when is kind of the mindset to really get yourself around in this circumstance. I mean, if you were to go out there and, just Google cyber, events and incidents, and, as we just kind of saw in the polling, most have been subjected to them. You're probably evaluating them. You're seeing, competitors, within your industry, being subjected to them. We're gonna, within the next 10 minutes, I definitely think stories and the real life and kind of diving into that is just the best way to kind of take, as we've, got some definitions and some key terms, kind of how does that apply within real life and, actually in practice. So, materiality, of a cybersecurity event, you kind of ask yourselves, well, okay, well, what does this mean? The SEC's, at least, their perspective, but this also, again, applies to, both private and public companies, is you really should be assessing, both those qualitative and those quantitative factors, and we'll dive into those. But in short, materiality, this is generally going to be understood as, was there a cyber event or incident that is going to be, significant enough that it would, impact an investor's, decision making as it relates, to that organization, to that company. And so, as Liz and Greg were both just talking about, this is where the Securities Exchange Act demands, you must disclose this. There must be disclosure for material cybersecurity events. So when we speak to quantitative factors, I think this is the easy one that everyone can relate to. This is your financial condition, what that monetary value was, operational impacts that resulted directly from the event. The qualitative factors are usually a little bit harder to quantify, to digest, but these are your reputational risks. This is your customer or your vendor relationships, competitiveness within the market. Also too, it's your organization, but it's so important, and we could spend a whole nother session talking about third-party risk management, but that customer and vendor relationships, if you have a significant customer or vendor who has access and your systems are, integrating with each other, or there's some sort of call it open door, for an analogy's sake, you need to, look into, investigate, and see, was there any potential leakage, into your environment that could have impacted your operations, leaking, going downstream to your financial and statements, your operations, and or, that breach of customer data and release of confidential information. And so getting into that too. So, we'll go into a couple examples, that have, recently within 2024, I think, really highlight, what are we, so taking those quantitative and those qualitative factors, okay, so what does that mean? I don't know if anyone, in the audience here recently has, had to go purchase a car. Maybe you had a lease that you had to turn in within the last couple, last month or so. But back in June, CDK Global, which is a information technology company, and they offer a platform, and service, which is pretty much the core technology that a lot of our automotive industry is using. Back in June, they were subjected to a cybersecurity ransomware attack, which ultimately ended up leading them to say to all of their customers who are using this core software, it's what they're using to get through their month-end processes. They said, be prepared to manually close this month. So, in today's time and age, that's huge. And they're still, this is very fresh. They're still working through it, but they're estimating, that's a $1 billion impact across the automotive industry, within the country. And I ironically enough was at a Toyota dealership the other week. I was turning in a lease, and I noticed they were doing everything manually. So I just knowing and being aware in this the space, I was asking, I was like, any chance you guys are on CDK? And he was like, oh yeah. He's like, and went into the fact that they were subjected to. And so, time is money. Automation is great, but when you remove that, the ability to return to manual, but they were having to do and record everything manually. So things that once took seconds were now starting, would take, maybe 10 minutes. And when you add that up, every single customer, every single dealership, every single, but not just dealerships, automotive, freight companies, it's very easy to, understand how we get to that 1 billion if you start to think there and the trickle down effect of that. So that's just some of those examples of those qualitative and, those quantitative factors at play. A more mature event and incident that actually ended up resulting with an organization. So I don't know if anyone was familiar with United Health, but they did have a material cyber event and incident that ended up, coming in through what was a Citrix portal, is how they feel the attack, originated. but it ended up resulting in 872 million, that they revealed in their Q1 financial report. So, and it ended up being around cash flows from operations in that first quarter. But essentially, that attack ended up impacting one of their key platforms that they used, and that key platform is what handled the transactions between doctors, pharmaceutical companies, healthcare professionals across the U.S. And after kind of running through that, and back in a federal hearing in May, they ended up saying they believe actually about 1/3 of Americans, like in some way, shape, or form, were affected through this attack. Whether it was, monetarily, it was just delay in service. So it's just, those are just kind of some very, very real, examples of, kind of seeing like that materiality in play. Kind of going back to that reputational, United Health, like, some companies might, significantly like look at, is this somewhere where we can trust, our health records, to be a part of. So it kind of plays into that reputational risk that, you have to take into account. That is, it's that dollar amount isn't known. And that's kind of what, from a disclosure standpoint, it's going to take a really long time to kind of assess that impact. But it's very easy operationally to kind of see the upfront like delays and, the ability or the prevention of being able to offer your services. So now kind of going to go into, and these are things, again, that are subjected to, private and or public, but want to take an opportunity to, and I was going to say, Greg, we can switch to the next slide, but kind of run into, for the SEC's, their ruling and their expectations, when companies aren't following that and they're subjected and required to, what does that actually look like? So the SEC has.
And as you do that, Stephanie, to highlight, this order is not necessarily connected to the new disclosure rules, because this happened a while back. But this is what you're about to tell us, is this emphasizes the importance they're placing on the accurate, adequate, timely disclosure of these events, right? So I do want to separate for our audience. This, I don't believe, is triggered by the recent rules, but again, it's indicative of the SEC's focus on this area. So with that, plow right ahead.
Yeah, no, exactly. So yeah, so the SEC, you go out there and you research, they have exponentially like increased their task force, as they're calling it, for their focus on cybersecurity. For anyone who, is a public company, if you are subject to, your audit's going to be subjected to an inspection by the SEC. One of their key things that they're focusing on is, did the companies, did they have cybersecurity incidences? And they're using that as kind of a weighted point, because they want to dive into, are these companies doing what they're supposed to be doing? Kind of going back to that concept of materiality that we were just talking about. Are they disclosing things properly? And do they have, a mature environment and kind of chain of command that's well established within the organization to, to promote and to disclose, these events as they occur, or at least have the discussions around from a governance standpoint, that the right people are in the room to make the decisions that, one, are going to impact management, impact the organization, but, that are very important, then kind of going back to that the shareholders need to understand and know for them to make, their investment decisions within those companies. So, back in June 18, and I think something kind of important I want to highlight, this was a recent cease and desist order that was made and, published. But this actually related all the way back to kind of to what, Greg, what you were just saying, like this was 2021, 2022, activity. So R.R. Donnelley, Sons & Co., just to kind of summarize like what was going on, and I'll kind of refer to them as RLD here, like throughout my explanation, but they were a marketing company who was subjected back in 2021 to basically several cybersecurity like events and incidents where there was a threat actor that was gaining access, to their organization and to critical key like customer information. And so it's kind of like why the cease and desist. It largely sums up to the 2 points in that RRD failed to, they didn't have designed effective disclosure controls. And, what that means is they didn't have that chain of command established that if there was certain activity going on, kind of subject to their like a very robust incident response policy, that information needed to be taken up the chain so the right parties can report and disclose, that a material event had occurred. And then two, they failed to carefully assess and respond to these alerts in a timely manner. So I want to kind of highlight there, kind of going back, and I'll go through some of the details of it, is that when we say timely manner, when we dive into like what actually happened at RRD, this began in the end of November, and their timely manner that they didn't like follow through on, they didn't start investigating truly until the end of December. So we're really only talking about the span of a month that part of their fine related to that, in what the SEC coined as they failed to carefully assess and respond. So it was just a month pretty much of which they were kind of ignoring activity or just not choosing to take action of, information that they were being provided. So, that's kind of where having that mature environment where you've got the right tools in place, you've got the right people and the bandwidth and bench strength, to, properly, when the information's presented, because we all probably, can relate to that, where you live in a world where there's a constant data overload. There's so much data that's being thrown at us all the time. So how can we digest it all? But I think it's having the right people, enough people, and or the right tools to kind of offset that to help digest it. But kind of going back to RRD, what they essentially had, they are working with a third-party service who are an MSP, who they were responsible essentially for, overseeing the network, making sure from an intrusion detection, like their prevention systems and their detection systems, they were kind of the eyes and ears on initially, looking and kind of responding to reports, responding to unusual activity and digesting it first. And then we're, responsible for communicating that back to management on, hey, we're seeing X, Y, Z, you maybe need to do something about it, or let's investigate further. So that's kind of what was going on. But then on R&D side, they, it's kind of year end, right? That's budget season. We're trying to prep for, year end processes. We don't know exactly the situation, but what we do know and what was reported in the SEC cease and desist is that they did not react. They, and they did not escalate. RRD placed a lot of reliance on their MSP, and there's plenty of organizations that, do, and that's definitely kind of, that goes back to that third party risk, but you got to be mindful of that. And so the MSP also, though, this is kind of where sometimes too much trust in the vendors, they didn't escalate several alerts to RRD for, contaminated machines, endpoints, that the data was clearly articulating to them. And so what it resulted was that threat actor was able to install encryption software on several of RRD's endpoints. They exfiltrated about 70 gigabytes of data, 29, including data that resulted, or that was belonging to 29 of their 22,000 customers. But some of it was personal identification and financial information. But all in all, this resulted in a 2.125 civil penalty that the SEC brought down on RRD. So again, I want to go back to that. All of this occurred just in the span of a month. So kind of going back to the point Greg had made earlier, it's 4 days required to disclose once you've identified a material event. If there are opportunities and options that, because again, too, there's research out there that says that, maybe it typically takes organizations about 70 days to kind of go through and organize and understand like what is actually going on with the situation. So there is, if you are, for the public companies, there is, under the 8K, it's 8.01. If it's, you haven't gotten to the point where you've assessed the materiality of it, but you do feel the need to disclose it because you feel like it might be weighted, it's important enough to consider. There are kind of other opportunities and streams for that. But again, this kind of just goes, to explain just kind of how important it is. And just also too, that, the SEC is looking at this and that task force they raised, they are going to be going through and assessing, like, did the organizations do what is mandated by that Security Exchange Act? And I'll just kind of cap off with, I was going to say, Greg, we can move on, but I'll just kind of cap off with, what is this kind of.
You got a good list here. Hit your favorite out of this kind of list of the folks in terms of what they should be thinking about.
For sure. I would just say that documentation is everything. And that if and that you're, the proper tools and the personnel, based on your organization size, and the industry that you're in, what regulation you're subjected to, in country, out of country, if you're operating globally, taking that all into account. But like, the documentation is key. Like, if you are experiencing your cyber, like a cyber event, like having a very, very strong incident response policy, and then articulating that, having training out to your personnel. Most of the cybersecurity attacks, like the ransomware and everything, it still boils down to a lot of times that human element. And so properly, like, educating your people, subjecting them to security awareness trainings, letting them know, don't ever just click a link. If you're not expecting it to come, don't click it, whether that's through your email, your phone, because we use our phones so much more these days because of the multi-factor authentication measures. But criminals are getting, they know that. So they're starting to target, personal phones that much more to be able to access through your phone, and then kind of into, through email, and they can look at that as a backdoor. So, just very important. So I would say the documentation is key, documenting everything from your incident, policy, like all the way to, if you have one, and then the investigative measures that you're conducting and that root cause analysis on understanding, how did the cyber incident, occur? What did you do to fix it? Making sure, how did you assess to understand, like, is it material or not? I would say is key. I know we're definitely kind of running on time, and there's so much to be said about it. But if you have any questions, please don't hesitate to reach out.
Good stuff. And like you said, other things on the list, equally important, real focus area, both for publics who have the disclosure obligations, but privates who have to manage their business as well. So some good points here. We're going to go to the next topic here. We're going to literally bring up Adam, who, as again, I'm sharing an office. He's been sitting in the chair. He's going to come up and address us here. For private company counsel update, I'm going to steal one element of Adam's thunder here, because he's going to talk about some members being reappointed to the PCC. He was one of them, and that is not a rubber stamp process when you get reappointed to a working group that you've been appointed to for the FASB. So kudos for him on that. And one other feather in his cap, he's presenting this time under a new title as partner with our firm, as opposed to the director title he had before. So congratulations to Adam on that. We're going to turn it over to you and let you give us a little update on what the PCC is doing.
Thank you, Greg. Appreciate it. Let us do this little switch here. We really appreciate the opportunity to come and speak to everyone here. I am a member of the Private Company Council, and we are the primary advisory board to the FASB on private company accounting issues. We're also the only committee that gets to kind of control our own agenda, which is a big deal in the financial accounting world. And we really take our job very seriously, and we're at an interesting point in the history of the Private Company Council, the PCC for short. If you think back to 2012, the Private Company Council began, there was really a lot of fervor in our industry of, we need the FASB to pay more attention to private company accounting issues. And that initial council came out, and they provided a suite of private company alternatives and really hit some what I call low-hanging fruit, areas where private companies were really frustrated with the accounting process. So they allowed for amortization of goodwill, allowed for easier accounting and practical expedience on accounting for identifiable and tangible assets and business combinations, some BIE scope exceptions for common control leasing arrangements, and then simplified hedge accounting for interest rate swaps that are pretty common in the private company environment. Over the years, the council has really been more involved up front in accounting standards. So I can tell you, having now served my first term on the council, that we are very much a lot of ongoing discussion with the board when they are deliberating accounting standards. So In my eyes, it's really been a really big win for private companies, because instead of trying to come up with expedients and alternatives at the backside of the process, we've been able to really be part of the process and make sure that accounting standards are considering private company needs in addition to public company reporting requirements when they're initially addressed. And I think we saw that pretty heavily in the lease standard, and that there's a great slew of practical expedience and private company concerns in that lease standard. The downside of that is it's not very visible in what we're doing. So, now we are now just took on our third chair of the Private Company Council, and we're hearing from the private company community, like, well, what are you doing? Because we don't see these alternatives being addressed anymore. And so we've taken this opportunity with the new chair and now kind of our third generation of the council to do a clean slate on the agenda and just make sure we're working on the right things. So with that, we've hit a short list of about 4 topics that we're currently looking at and trying to consider whether or not we need private company alternatives or to make other practical expedients or other changes or even additional guidance in the private company world. So what our short list is today is, first of all, credit losses, the CECL implementation. And essentially, particularly for trade AR, folks have come out to us and said, I did a lot of work and I did a lot of documentation for CECL, and it didn't change anything. And does this really impact me if I'm just a manufacturer with trade AR? So that's one topic we want to look at and consider. Is the bang worth the buck exactly on CECL, or is it just a documentation exercise for certain private companies? Obviously, for financial institutions and others, the CECL is far more impactful and probably a lot more value. Debt modifications and extinguishments, if you've dealt with that, this can be a really hairy area of accounting. So it seems like it's right for potential simplification, particularly for private companies that tend to have complex debt structures. One practitioner brought up that they're pretty sure a lot of their clients aren't aware that there's a 10% cash flow test, for example, and trying to determine if there's been a debt extinguishment versus a modification. So it seems like that one is ripe for opportunities. We'd love to hear your impact here soon, hear your thoughts on whether that's a worthwhile goal or not. But we certainly think that there might be there. We'll have to establish a working group to really dig in on what exactly we could do and what exactly the board would be willing to allow us to do on that one. Presentation of conditional retainage and overbillings as contract assets and liabilities. This is really specific to contractors, and it actually came to us from the surety industry. We have some surety representatives on the council, and maybe it was unintended consequences of adopting revenue recognition in topic 606. What's happened there is contractors used to display these in gross on their balance sheet, and that was really primary information that sureties and other users of those financial statements were looking for. And upon the adoption of 606, there's been a lot more netting as required under the standard. And the users of the financial statements have come to us and said, we're not getting the same level of information we'd like to see. Now, some entities and firms have been disclosing that information separately, but there's a lack of consistency. I think that one is pretty easy, slam dunk. Yeah, we need to do this. When you hear that something's hard to implement, and then you hear that also that it's not getting the right information to the users, and those are the primary goals of financial reporting. So I certainly expect us to be able to make some changes there, whether it's private company only or maybe broader, we'll see. And then lastly, although the leasing standard did have a number of private company practical expedients, we think there's more that can be done. So we're going to start a working group and really take another long, hard look at leasing. Just try to figure out if there's more we can do there in the leasing environment, and it provides some additional practical expedience. With that, Greg, we'll switch around here. I've got a polling question.
We do. We have a polling question we want to put out there. It's going to give Adam a little help here as he goes back and talks to the PCC about their 4 agenda priorities. So if you'll respond to this, and if you're not private, pretend that you are and answer it as if you were. What of the 4 that Adam just listed there for you, would be of most interest to you? And so we'll look for those results, and that gives Adam something he can share with the PCC next meeting. as we do that, we're going to transition to a point that Liz wants to bring up. Liz, for those that know, internally is also known as the leasing queen at the firm, as contrasted to the dancing queen from ABBA. She is the leasing queen. And Liz, you do like to share with us, and it's very helpful, things that you start to see trends in comments. So with that, you've got a trend you've noticed that you wanted to share with this group.
Yeah, and I'm just going to say I'd rather be known as the dancing queen rather than the leasing queen. And I'm happy to share some ideas for lease accounting simplification. But today's topic is on leasehold improvements. And this is something that's really not entirely different than what we had under the old lease standard of ASC 840. And look at that. A lot of people want some lease simplification. I'm not surprised at that, as many times as we've talked about it. But one of the things to think about is that leasehold improvement really owned by the lessee, or is it rather actually owned by the lessor? And who's paying for it may or may not matter, Greg. So a lot of people go, well, if I'm paying for it, it must be a leasehold improvement of mine. And that is not necessarily the case. So what we call this, who is the accounting owner of the leasehold improvement? And in plain English, what I think you need to think about is whether or not the improvements have an alternative use to the lessor, and alternatively, is the lessee consuming the majority of the economic life of the leasehold improvement through the lease. So it could be there's no alternative use, but at the end of the lease, there's hardly any value left, and I've consumed it all as lessee. Those are going to impact whether or not I am, as lessee, the accounting acquirer. So I've provided two, what I hope are simple examples. So let's go to the first one on a 5-year lease that commences on May 1. 800 grand of upgrades are going to be paid by the lessor. 200 grand of upgrades are going to be paid by the lessee. I've called these generic upgrades of drywall and HVAC. They have a 20-year life. So I've got a 5-year lease. I've got a 20-year life. But the lessee is paying for $200,000 worth of those upgrades. A lot of lessees would have said, because of that, they have at least 200 grand worth of leasehold improvements. The lease is signed on January 1. Remember, it commences on May 1. Construction starts on January 1. And the property is actually ready 1 month early. And as the keys are handed over and the property is handed over on April 1st, who is the accounting owner of these leasehold improvements? Well, based upon these facts, doesn't look like there's an alternative use. There is an alternative use since they're generic, and 5 of 20 years we're not consuming the majority of the life. So therefore, the lessor is the accounting owner of these improvements. What do I do with the $200,000 payment as lessee? Well, that's prepaid rent. That is not leasehold improvement. It's merely prepaid rent. When do I start expensing rent? You would start expensing it on April 1st when the property is turned over and you have control of it. So be very careful in your negotiations with the lessor about when the property is going to exchange hands and when is control going to be handed over. Obviously, Greg, there's always judgment in this. I'm trying to create something that is on one end of the spectrum, so it's a little easier to see where the judgment is falling. Now let's compare this to the next example, the next slide. And I may have confused everybody with a couple of the words on this second example. So let's just I will amend as we go along. Same this case, it's a 10-year lease. It commences on May 1. There are some generic upgrades, but embedded in there are some custom upgrades. And those custom upgrades have a 10-year life. So if the generic upgrades have a 10-year life, and this is a 10-year lease, we're on one end of the judgment spectrum, right? If it's a 20-year life and it's a 10-year lease for generic upgrades, oh, that judgment is really going to start to kick in. And I'm not sure that 10 of 20 years is the majority. Might be half, but it doesn't sound like the majority. So let's just replace generic upgrades with custom upgrades so that we make this easier to understand. It's a 10-year lease with custom upgrades that have a 10-year life. The life seems to not matter anymore because these are custom. They don't have any alternative life. Let's say it's the Forvis Mazar's name on a building. That would have no alternative use to the lessor. Again, the lease is signed on January 1. Construction starts on January 1. The property is ready 1 month early on April 1st. Who's the accounting owner of these custom upgrades? Oh, I'm going to say in this case, it's now the lessee. What do we do with the $200,000 payment? Well, that's going to become leasehold improvements that you're going to be amortizing over the shorter of the lease term or the life. What do you do with the $800,000 payment? Well, in the prior example, the lessee would do nothing with it because we don't care. It's not our upgrade. It's something accounting for over on the lessor's books. But in this case, the $800,000 payment, since these are my leasehold improvements as the lessee, the $800,000 payment becomes a tenant improvement allowance, and it will start to impact the right of use asset. And when does rent expense start to get recorded? And this may be the big change. It's going to start to get recorded on January 1st, because that's when construction is occurring. That's when control is taking over. And one of the things that you see in the literature out there is, what are you renting? Are you renting a fully built out facility, or are you renting one that's got an upgrade that you require, for example, very specific equipment, very specific, very specific build out. All of a sudden that can change the timing. Listen, I know that these examples are not perfect, and I know that likely you don't fall into these, but if you're listening, pay attention to how long is the lease, how custom are the upgrades, are you consuming the majority of the life of those upgrades? It will impact how the lessor is accounting for it. It'll impact how the lessee is accounting for it. It'll impact the timing of the lease rent expense. It'll impact the totality of the lease liability. And this may be one that you want to reach out to your accounting advisor to make sure that you understand, and before you sign your next lease modification or your next lease, make sure you understand the nature of those leasehold improvements. That was quick. I get it. Just trying to seed everybody with some thought points going forward.
No, good stuff there, Liz. And I know I, for one, am very happy that I get to call you when I see those leasing questions, because there's a lot of nuance there in terms of the nature of the asset. There, a lot more judgment, perhaps, as you said, than what you've baked into that example when you're actually looking at a real life fact pattern. So a lot of nuances there. Certainly appreciate your thoughts there. Kind of moving to our last section, we have conversations you should be having. What do we see coming up here in the near term? Want to push the next polling question out there, though, in terms of, you know, things that you've heard today that you might be interested in hearing more about. But as we do that, Liz, let's see. As we look at what we think's coming up, folks should be talking about now. What have you got for them?
Yeah, so I would just be paying attention going forward to PCAOB standards and AICPA standards that are coming. I'm going to suppose that the majority of our listeners are not auditors, but they are maybe people who work with audit firms. And it's always interesting to know what is on the horizon for the firms to have to tackle. Are they new accounting standard reactions and audit standards in reaction to an accounting standard? If you've got that accounting transaction, you might want to know what's happening over on the audit perspective for the transaction. If it is something about the quality control of the firm itself, often that's going to lead to more structure, maybe more process, maybe a change in methodology, maybe a change into how they are asking the clients for information to evaluate continuance that might be impacting their cost structure as a firm. So very simply, pay attention to what's happening over on the firm side for standards that are out there and coming.
Yep, absolutely right. As we point out from time to time on this, change in an AICPA audit standard, privates are going to feel. Change in a PCAOB standard, publics are going to feel, but there's often the trickle-down effect as a firm has done something to respond to that and they roll it into the totality of their methodology, or the AICPA as a standard setter says, hey, I need to look at that as well. So those are often times some interrelated things there that our clients will feel the impact from, even though they are the standards for their auditors. So some good information there. I want to hit one real quickly here. Again, we've touched on this a time or two. We're not going to go into detail, but remember, for our publics, you have new segment disclosures that are coming up this year. They will be made in your K, and then going forward, they will be made into quarters. New information that's required, some new segregation of certain expenses, some new reconciliations, if you will. So again, we don't want to drain that. So those that have been making segment disclosures, you've got some things to think about. But importantly, those that have not made segment disclosures, you have determined you are a single segment company. Well, the FASB determined, you know what, there is some information in the segment footnotes that aren't necessarily inherent in your full footnotes. So even if you're a single segment company, we think there are some things that you need to talk about. So these segment footnotes are being expanded beyond those with segments, plural, to the single segment company. So there's something in this one for everybody that's a public company. Want to make sure you're keeping your eyes on that. Again, building into what you will need to disclose in the case this year. The last point here, just kind of for your consideration, the SEC came out with a statement. Eric Gelding, who's the director of the Division of Corporate Finance, put out a publication. It's not long. It's about 8 or 9 pages, double space. It's not a bad read. But in that, talks a little bit about how CorpFin works, talks a little bit about what they have been reviewing in the past, but importantly, tease up some of the things they will be reviewing for as they go forward, looking at this year's filings and in this filing season, registration statements, Ks, Qs. So for companies that know that in advance, you might be able to polish up a little bit, maybe see what they're looking for, see if you've got enough words around that, because the more you can do to head off the comment, the better. Once a comment's made, that gives them something, a thread they can start pulling in terms of finding something else to ask about. So just some thoughts for you to take a look at this. They talk about financial reporting focus and SEC disclosure focus. Financial reporting focus, they've said, we're already telling you we're going to look at your new segment disclosures. We're going to look at non-GAAP measures and compliance with those. Now, they seem to comment on that every year, but the amount of focus seems to ebb and flow. They're telling us we're going to look at non-GAAP again this year. Critical accounting estimates and MD&A, we want to look at that. Typically, they are focusing on you're disclosing more in MD&A about sensitivity than you are required in the footnotes. And then they're going to look at disclosures related to supplier finance programs, an odd arrangement whereby if you happen to buy from somebody, they want to factor your payable, factor their receivable, get their cash earlier, give an arrangement where maybe you can still pay later. And it's a very constructed program in terms of payables. If you're in as the payable payer, there's some disclosure requirements around that. SEC focused disclosure, the things that they own, if you will. They're going to look at China-based companies and your interaction with the government there in terms of restrictions, continued impact of inflation, continued risk for banks in terms of liquidity and interest rate, new trends. What are you talking about? Artificial intelligence. What are you talking about? Commercial real estate, and their new SEC roles. So those will be focus areas for them. So with that, Liz, team, we've kind of come to the end of our webcast here. We do have a slide here, as we typically do with some of the publications we have that might relate to something you heard today. Would recommend that to you. And with that, we want to thank you. We will again be coming to you in October and January. And as you get opportunities, click on the button here if you downloaded the slides in order to register for those. We look forward to having you back for our future installments. With that, I want to thank everybody for your participation and have a great afternoon.